As I discussed earlier, the digital age has changed virtually everything to the point of being almost unrecognizable. So when we see evolutionary change to the degree that we have for the last 10 years or so, we have to go back and look at all of the old theories, beliefs, conventional wisdoms that we've assumed that are true. They've been around for 30, 40, 50 years. And we have to look at them in a whole new light and determine whether or not they're still relevant in today's world. So we'll start with investing, and we're going to look at the universal assumption that we kind of live by in dealing with markets, and that's the risk-reward relationship. Does taking more risk actually produce higher returns? In other words, we believe that if you need to make more money, you have to take more risk, and the more risk you take, the more time that it takes to get to your average expected return. So let's go to the stock market, and I'm going to take a 100-year period. And if we look at the market over the past 100 years, the average return has been almost exactly 10%, which sounds pretty good. So if my return was 10%, I would kind of expect at the end of each year to get somewhere in the 6 to 14% range. If I'm a little below it or above it, I'm either going to be disappointed or really excited. So the question is how many years out of 100 do you think the market came in at a return somewhere between 6 and 14%? The answer? Only 13 times. 13 times out of 100 years. So I'll explain this in another way. 13% of the time, we are getting what we expect. This is what the investors want, somewhere between 6 to 14%. This is the reality of what they're getting. Returns that are all over the place. So in other words, if we look at the red dots, we're going to see that our risk is 20, 30, 40% in an attempt to try to average somewhere between 6 to 14, which is rarely going to happen anyway. So what we're beginning to see is that the amount of risk that we take versus the average return is way out of balance. So if we go back to our original question, do we need to take more risk to get a higher rate of return? The answer is no, because risk is defined as higher volatility. Higher volatility is a sign of inefficiency and is a bear market characteristic. And drawdown or decline, how is taking a larger decline in my portfolio going to actually help me make more money in the future?